Hello, I'm David Hogarty from KBI Global Investors. I'm here with my colleague from the Global Equity team, John Luby. We just wanted to have a quick chat about 2017. It's been a very unusual year for equity markets, and particularly in emerging markets. It's been a very challenging year for our relative performance. John, how come things have been so difficult for us?
Well, I think the behaviour in emerging markets this year, David, has been incredibly striking. Now, obviously the performance itself, almost 20% year to date, is very striking in itself. But it's really when you look underneath the bonnet and realise that the vast bulk of that performance was actually driven by a handful of names. That's the really striking point. And that's led to a situation today where just 5 stocks out of an investable universe in emerging markets of 846 now account for over 20% of the index. Now, I think that's a really significant point. And investors, as we look forward from here, really need to be cognizant of the risk they're taking because of that concentration. So I think lots of investors out there thinking positively about emerging markets, and I think they're right to think positively about emerging markets. There's lots of good reasons to invest in emerging markets. But if they're taking the passive approach, which they think is simple, they think it's cheap, they think it's the way to go, they're ending up, I think, today with an exposure that's very skewed, very concentrated, and I think that's a danger for them. So for us, looking at the marketplace today, the risk is very much in that index. Now, I know you yourself have given quite a lot of thought to this passive tsunami, which really has been a significant driver of emerging markets this year.
Yeah, well, I mean, it's the idea that if you buy a passive product, 20% of your investment ends up in 5 names, which is a huge stock-specific concentration from what people think is a diversified, relatively low-risk investment exposure. It's a great irony. It's the opposite of what they think they're buying.
Yeah.
And I think if you multiply that out and think of the mechanics behind it, Tencent, which is the largest stock in the benchmark, is 600 times larger than the smallest stock in the index. So just think about that for a minute. Every time you invest in a passive product, 600 times more money gets allocated to the largest stock than the smallest stock. Not based on any information, not because anybody's made a decision that it's a better investment or will give a greater return. It's simply the robotic mechanical dynamics of market capital weighted investing. And that's very dangerous and leads to valuation dislocation.
Sure.
And by the way, the same is true the other way around. When people disinvest or take money out of a passive product, they have to sell 600 times more at Tencent than the smallest stock in the benchmark. So that, for me, creates a dislocation between the current value of a stock and its underlying intrinsic value, which is what you should be purchasing.
Yeah.
And I think what people have ended up with is this kind of concentrated stock exposure, which rather than being a diversification of their developed market exposure, which is why you're supposed to be investing in emerging markets in the first place,
Sure.
It's actually just an extension of the same beta. It's the same e-commerce play in a more stock-specific, aggressive way. I think that's very troubling.
Yeah, it is, and it has had that distorted effect on valuation. So from our point of view, for example, those handful of names that are now dominating the market and have dominated returns really look very expensive. So again, no matter what growth expectations you have, and obviously lots of people have very positive growth expectations for these names, and maybe that's well justified. I mean, we're not at all saying these are bad businesses, but certainly at this point, because of the demand for them, because of their performance, they really are valued in a fashion that really lots of good things have to continue to happen for them to continue to perform. So again, I think that's risk. And again, you've seen that broader trend in the marketplace where growth names have excited people and they've been prepared to pay up for them. And I think that really has led to a very significant valuation distortion in the marketplace, particularly in emerging markets.
Yeah, I think it's important to say that equities generally are not overvalued.
I think that's
just
fair.
Particular pockets of the market.
Yeah.
And that's kind of another frustration, I guess, for us, is that you see stocks which are, we believe, incredibly overvalued become continuously attractive. Whereas actually there's lots of stocks that are very, very cheap out there that offer very similar potential return over time. The portfolio that we have at the moment, you're seeing an annualized dividend growth rate of over 17%, which is phenomenal. You're seeing those dividends be really well covered by free cash flow, almost 3 times coverage.
Sure.
And it's financed from less than half the earnings of companies. So that for us is a very solid, very reliable, very stable source of return, and you can buy it all at 10 times multiple. So there's clearly something wrong when you can generate a portfolio like that with the potential returns that it has to offer. And you still see all the flows going to the more expensive end of the market.
Well, I think it's a really significant point, and I think that last point in particular about the multiple being 10 is really important, because again, as we look forward from here, we really need to think about where we've come from. And really, it's really 3.5 decades at this point, if not longer, that markets have really benefited, stock markets have benefited from this tremendous tailwind of falling interest rates, falling bond yields, falling discount rates. And it's undoubtedly the case that that has driven certain segments of the market in a very significant way and left other parts of the market trailing in their wake. And I think that change, that likely change in that interest rate, bond yield and discount rate environment, and that tailwind finally coming to an end will be significant. And I really feel that stocks which have that valuation attraction will come back into vogue in a very significant way. So I think as we look into 2018 and beyond, that changing broad environment on monetary policy and interest rates and bond yields will be very significant for stock investors.
Yeah, I think that's right actually. And I think it may surprise people because we have dividend orientation,
Yeah.
but we'd actually welcome a change in the monetary regime.
Absolutely.
We'd welcome a rising rate environment.
Yeah.
It should be very helpful for value-oriented portfolios.
I think so.
And dividend growth-oriented portfolios. If you look at periods historically where interest rates have gone up, actually this one we've tended to outperform the best.
Yeah.
So we keep our fingers crossed for 2018.
Indeed.
And keep the faith for the future.
Absolutely.
Thanks very much for watching, everybody.